Options are financial instruments that allow you to trade a certain underlying asset in another way than just by buying or selling. We're focusing on Forex vanilla options, for which the underlying asset is a Forex pair. We will assume that you have some prior knowledge of the Forex market and trading. Vanilla options were the first type of options to be developed and are the building blocks of the option market. They can be traded one by one or combined into option strategies. There are put options and call options, and we'll take a look at what those are. Puts and calls. An FX vanilla option is either a put option or a call option. A call option gives the buyer the right, but not the obligation, to buy the underlying asset, in this case a Forex pair, at an agreed price at a given point in time. A put option, on the other hand, gives the buyer the right, but not the obligation, to sell the underlying asset at a given rate at a given point in time. Having the option to trade an FX pair in the future at a predetermined price is very valuable. The value of this option is called the premium. The cost to purchase an option is the premium. The buyer of the option will pay the premium to the seller when the contract is entered. The risk for the buyer of an option is limited to the premium paid. The seller, however, has the obligation to enter into the FX transaction should the option be exercised, and therefore faces unlimited risk. For taking this risk, the seller received the premium for the option when the contract was entered. Consider the premium as a payment for taking the risk. Strike and expiry. When entering an option contract, you need to define the following: the trade amount, the underlying currency pair and type, and whether you wish to trade a put or a call. You also need to define a strike price and expiry, in other words, for how long the option should be valid. Strike is the price at which the holder of a call option can buy the underlying Forex pair, or where the holder of a put option can sell the underlying Forex pair at a defined future date. This defined future date dictates the lifetime of an option, and it's defined by the expiry date. If the expiry date is defined as 1 month, for example, it means that from today, after the deal has been confirmed by both parties, the option is valid until the date of expiry, 1 month from today. Options can be traded in different styles, with different methods of exercise. We're referring to European style options, which means options that can only be exercised on the day of expiry. So what happens on the date of expiry? The holder decides whether the option should be exercised or not. As we're looking at European style options, this is the day that the holder of the option will decide to exercise the option or to let it expire. If an option is exercised, the holder will either sell to the writer at the defined price, the strike, if he had a put option, or buy from the seller at the strike level if he had a call option. If the option is left to expire, there is no transaction between the buyer and seller on the expiry date. Volatility. There are several factors influencing the price of an option. Option pricing has similar logic to insurance pricing. The longer the time period you want it to cover and the more variables you want to allow for, the more expensive it's likely to be. An important parameter when pricing options is the volatility, or rather implied volatility. This is a measure of the magnitude of movement that the underlying asset is expected to have during the life of the option. The bigger this volatility, i.e. the more the FX pair is expected to move up or down, the more expensive the options will be. Due to their versatility, FX options are not only used by speculators, but are also popular as a risk tool for hedging unwanted or commercial exposure in the market. The Greeks. Option traders constantly measure the sensitivity of an option or an option portfolio to the various pricing parameters, such as the FX spot price, interest rates, or implied volatility. Those sensitivities are referred to as the Greeks, as they're named after Greek letters. Greeks can be thought of as risk measurements, as they each define a certain risk associated with a particular option. The main Greeks that an option trader needs to know are delta and vega. Delta indicates an option sensitivity to the exchange rate of the underlying FX pair. It changes during the lifetime of an option. As a result, your exposure to the underlying FX pair when trading an option will change accordingly. Vega indicates the sensitivity to changes in implied volatility of the underlying FX pair. It indicates how much the value of an option contract changes by when the volatility changes by 1%.